All right, folks, we're looking at the daily chart for the NASDAQ. And if you're looking at trading view under the NASDAQ selection, so it's the continuous contract. That way it makes all the candles look nice and crisp and you don't see any spotting. So right away, if you're looking at this, you should see this run on price, taking out buy side liquidity. See all these relative equal highs here? Ran above it, then broke below a swing low. Created what? Fair value gap. Trades up into it. Now where's it going to trade to? This low to this high, midpoint. There's a gap right there. And then you have the old low. Sell here, aim here, or here. And it runs it out. Now, this is important. Obviously, it sounds like, well, you're cherry picking in the pack old moves. Okay, that's how you learn. But think about what's happened on the daily chart. We traded below this low. We've taken sell-side liquidity out of the marketplace. So with that, it's likely to retrace back up into the range. What's the range? This high to that low. But look closer. See how we have this nice energetic run? Look how many down close candles we have here. 1, 2, 3, 4. A lot of movement there. So I'm looking at this high and this low. And I'm trying to get a range for where we are at present. So once the sell side was taken out here, it's likely to retrace back inside the range of this high and this low. We've seen it come all the way back up. It went to a premium market, which is above equilibrium here. And then we went down below to a discount, bounced off of the old low here. Then we've consolidated around equilibrium. Now, when you have this condition, it can make it very difficult to get a true reading on bias. Okay, so there's times when even me as ICT, I don't have a good, clear read on what it is I'm looking for. So I have to demand more price action and more information, or intel as I like to call it, based on what the market's going to do right after the open at 9:30 in the morning, New York time. For disclosure, in my own paid membership, I mentioned to them that I felt that this was a likely area where they could probably take it down there and sweep that area. Whether it goes lower or not, it's irrelevant. But where we were here to here, that's what I was expecting, some type of move last night for Tuesday's trading. Okay, so Tuesday's trading, the 8th of February, 2022, going into the marketplace, I was anticipating something that would be bearish. That's going to be useful to us when we go into lower time frame charts, because I'm going to show you what I had to deal with this morning and how I had to overcome that. And this is something that if you're using these concepts and practice with your demo account, you're going to have these same conundrums and you have to find a way to overcome them. And I'm just going to suggest this to you here. But before we go into the lower time frames, I want to teach bias. Okay. So if we have this set up on a daily chart, market structure has a shift lower, we trade up into a fair value gap until we get down to here and here. Each day, I'm anticipating lower prices. So my bias is bearish. Now, every single day is going to be a down close candle. But I'm going to hunt intraday price action with that in mind. If I'm going to take a long, it would be counter trend to that bias, my leverage is going to be dialed back. So let's assume for a moment that the account that I was trading with would allow me to trade 10 contracts. 10 contracts would be the maximum I could trade. So if I'm trading with the bias, which would be bearish during the run from here to here and here, then I'm going to look to utilize the maximum leverage that I can have without over leveraging based on a fixed percentage basis. Like I like 3.5%. I'm not telling you to use 3.5%. You should be risking less than 1%, about 0.5% or 0.25%, because if you don't know what you're doing, there's no reason to be putting higher levels of risk behind a move if you don't know what it is that you're doing. It's going to create toxic thinking, bad habits, and you're going to be afraid to execute based on the results you're getting. So you want to be indifferent to the results. And that in the beginning is important by having a demo account, using very, very low leverage, if not deleveraging. Okay. And I'll talk a little bit about that when we get into money management, but that's not this topic. So from this high down to that low, each day I'm going in with the expectation that it's going to likely set up a sell scenario where I can get short and hopefully buy back at a lower price. Count how many up days or green candles there are from this high and this high down to that low. 1, 2. Real important. So the delivery by the algorithms are spooling. That means prices expanding and going directionally one way. When that occurs, there's going to be times where you have an up-close candle. That may be a day that you tried to go short and maybe you've lost. Okay, no big deal. Same thing going into the next day, going in for looking for shorts. Next day, same thing. Same thing. And then here, it opens and trades down below the low and has a huge expansion move and then comes back above and that's it. It closes on the near the high of the day or midpoint of the body in this area here. Is there a lot of up-close candles during that bias being bearish? No. You need to get over the concern about being right every single time. You need to put aside also the idea of perfection because you're not going to have it perfect. You're not going to get in perfectly. You're not going to get out perfectly. You're not going to have the perfect amount of contracts. You're not going to have, the perfect asset. In other words, you may be trading the NASDAQ and the E-mini S&P has a little bit better run and delivers a little bit more. Highly unlikely, but vice versa. You get what I'm saying. So you're always going to find reasons to be wrong. Embrace imperfection. Embrace the idea that you don't have to know everything. You don't have to be right. Okay? Being right is not equivalent to being profitable. Very important factor there. So with bias, in short, you're looking at your daily chart to get a read on where it's likely to go to next. Where's the price going to draw? Is it going to draw higher to an old high? Is it going to draw down to an old low? And until it gets that high or low, you stay with that bias. Okay? So it's a quick down and dirty way of interpreting price action for daily bias. But the folks that I've taught that are hung up on daily bias, really what they're trying to say is, and this is exactly what they're getting at, but they can't either articulate it or they just won't be honest with it, or me. What they want is, tell me how to get the high of the day when it's bearish and how to get out at the low and get all the move and never take a loss. And avoid when it's going to be a day that goes against me where I feel uncomfortable. Now that might sound extreme, and maybe some of you that have issues with daily bias are thinking to yourself, that's not me. I just want to know when it's going to go up, when it's going to go down. I'm telling you, if you strip it down, that's what you're trying to do. You're trying to demand that I give you some magic bullet that's going to give you the absolute highest high and the lowest low on the bearish and bullish days. So that way, you're trading perfectly. I don't trade perfectly. No one trades perfectly. So you have to have this embracing of the gray area in the marketplace. That gray area is where things aren't always so clear. But because of experience you've had in the past, seeing things unfold the way they hopefully would if you've been trained properly, then there's nothing to fear. Even if you do it wrong and you have an adverse reaction or result to taking a trade using the logic that you're training with, there's no reason to be fearful because one or two or maybe a small string of losing trades does not in any way, shape, or form diminish the effectiveness of a model if it's based on sound logic. So you're going to utilize the daily chart to determine whether or not the next candle is going to be likely bullish or bearish. Between this high here, in the midpoint of this low to high, I'm expecting down close candles. That would equate to a bearish bias. It doesn't mean that I can't take a long entry. It just means that if I do take a long entry intraday, I'm going to do it with far less leverage. And if I see a setup that's bearish, I'll use or consider using, not always, but I'll consider using my maximum risk, which is 4.5%. But I like to see trades that I feel comfortable with 3.5%. until we get down to this low, and underneath it, that means it's likely to reverse or consolidate. And we have a retracement back in. So once it starts doing this and it's hanging around equilibrium, it gets very difficult, even for me, to determine a bias. So what does that mean? No trading? No. It just means that you have to rely on the smaller time frame intraday charts and just simply look for liquidity pools. So you're going to trade intraday volatility, running old highs, running out old lows, being a lot more nimble, and like a surgical strike. You take your handles or your points that you're trying to get out of the marketplace and then run. You don't try to overstay your welcome. So let's go down to a lower time frame. All right, so we have the 15-minute time frame, and we have our 8:30 in the morning crosshairs here. Crosshairs are the vertical line that denotes the time that we start looking back to the left. Okay, right here, go to the left. We see here, this is our first low. So we mark that. And right in here, first to the left is here. We don't want to use this low by itself because it's inside of this candle. So I want to use the extreme. Where's the liquidity going to be? Is it going to be above this? Or is it going to be above that? It's going to be above this. Okay. Why? Why not that one? And why this one? Keep looking left. What do you see over here? See that? These are relative equal highs. What does retail traders see that as? Resistance. So they see it going up to here, stopping and going lower. They see it going up to here, failing to go up here. So now they think this is a really strong resistance level. And it went lower. Look at that. Then the market showed how that level is real resistance by going right through it. But this would be a first target here to reach for. And if you want to use a longer term intraday, target would be back here. Because to the left of this one is this one, which essentially is the same. Then we have this one here. Okay. So obviously with the benefit of hindsight, you can see that we traded below that low here. Then we reversed and started going higher. We took out this high here, which I traded this. I did not hold for this. Now, the question is going to be is, why didn't you hold it for that one, ICT? Well, if you look at the range from this high down to the low over here, about midpoint is just above this high, right? And we have this little imbalance right there. So what am I teaching you in this mentorship? I'm looking for about the midpoint and some kind of a liquidity. There's buy stops above that, okay? So we traded below. I went along on that candle. I'll show you in a live account. Trust me. Just hear me out. I bought a ride up here, and I took out on this candle here. I got out on that high. Now, I could have held it, but to do so would be painting the picture that you can do this and take down these types of trades all the time. When the reality is you're going to require a lot more time to develop than you probably think it will require. And one of the things that happens when I have students come under my tutelage is they have been fooled by listening to people talk about the left side of the chart all the time, and they can't execute on the right side. And it is useful in the beginning, but if that's all there ever is, and if your educator can't trade on the hard right edge of the chart, it kind of makes you feel, well, either a false sense of security or a false sense of confidence that quickly gets evaporated when you trade with a live account, or creates analysis paralysis. And I have a large body of students that are lumped into one of those categories. They've been utilizing some other concept or approach, or they call it SMC, smart money concepts. And they'll think to themselves that, this is what's going to have to happen in a chart. And it isn't, because they're lacking narrative. So one of the things that I'm teaching in this mentorship, in my paid mentorship, is how to view the marketplace from a narrative standpoint. What's the logic? Why should the market do what it's doing? It's not enough to see how a low is taken out and expected to go higher, or a high taken out and expected to go lower. There has to be some greater context behind it. And that's what I gave in the beginning of the video. Now on the 2-minute chart, why the 2-minute chart? Well, that's for your homework. You go through the 5-minute, the 4-minute, the 3-minute, the 2-minute, and the 1-minute chart. I'm going to utilize the 2-minute chart because this is what I was using today for my own analysis, okay? All right, so you can see how we had the old low here. We trade down below it. And this 1004, I'm actually highlighting that candle right there. The reason why I'm using that candle's low and taking the screen capture there is I want you to see the low candle's price. Okay, so that's where your stop would have to be, just below that, maybe one tick. By going long in here, based on the logic I'm going to start to outline here. The market trades below the old low. Trades below it, rallies above, but does it trade above this short-term high yet? No. Then it goes down once more, below the old low, but not below this low here. Then it turns and goes higher. What did I see in this chart that allowed me to go long in here? What did I see? Nothing. I didn't see anything in this particular chart. I saw it in the S&P. Before I leave this chart, I want you to think about how that high was around 14,620, and it was this candle here I got out at, that one right there. Then it retraced a little bit, and then went higher, pressed into the ultimate longer term high, sweeping the buy side there. Let's take a look at the S&P. S&P, similar situation here. High, that's the best case scenario for the day. This high here, that's where it could reach for, 830. We're right here. What's the point of expecting it to go above that? Not much. We want to see some kind of a protraction. So the market, yes, it went above that short-term high and then went lower than that low, yes. But watch what happens. It trades below it, comes back up, and look at all the volatility and the sloppiness inside this area here. Then the market starts to rally. So the draw on liquidity is going to be here. It took out sell side here. So let's look inside this price action and see if there's any details that would lead to a run into that, we'll call it the 44.95 level. Okay. So the 2-minute chart, this is what I was using. The market trades below the old low, as we see here. I apologize, the screenshot. I wish I wouldn't have had these things on it, but you can look at your 2-minute chart on TradingView and you'll see this a little bit more clear. I apologize. But this low candle, it's high. Then we have one candle up. The next candle's low. There's your fair value gap. That's the run in here. So we have displacement low and displacement high. Is there a market structure shift bullish? Yes. It trades up above it. And then you look for the fair value gap. Is there one in here? No. Anything in here? No. How about here? No, it's closed in with this move down here. But we have this. So we trade down into it here. At 1036, that candle forms. That's a long in S&P. Now, compare that with this fair value gap in the S&P. We traded below the old low. We took sell side out. We have a shift in market structure on the S&P. These averages tend to move in tandem. So that means they generally move in the same direction. So I'm looking at the Dow, even though you don't see me trading it, I'm looking at it. I'm also looking at the S&P, even though I'm favoring the NASDAQ because its volatility and its movement is more than the S&P. Other traders might be fearful of the volatility and say, oh, I don't want to trade that. It's too fast for me. I am loving this because I know how to trade. I can work within that volatility because I know what I'm looking for. I know the signatures the algorithm is going to put out. So until I get these signatures, I have to wait or put leaders into the marketplace, which is what I'm going to show you when I show you my live account results today. But at 1036, let's go back up to the NASDAQ. We don't see any fair value gap in there, do we? Nope. But we start to see NASDAQ turning. So I went in long in close proximity to this order block. Okay, I went in at 14,505. That's inside of this order block. So I'm trading close to it. Now, I promised I wasn't going to teach order blocks that much in this mentorship, and some of you have been leaving comments, oh, I'm not into this now because you're not teaching order blocks. Okay, go watch something else. I'm going to teach it the way I want to teach it. Okay, it works, and you have to get yourself acclimated to how I'm teaching it, or don't watch. Okay, I don't mean to be rude, but I'm not taking suggestions on how to teach you. So if we're expecting a fair value gap to be a launching point for the S&P, and these markets generally move in tandem, I don't need the fair value gap in the NASDAQ because I'm utilizing the S&P as my indicator. What did I just say? The word that should not be spoken. Indicators. Yeah. Even though I don't have them plastered all over my charts like graffiti, you can see the candlesticks in my charts. You can see the logic. You can see how the markets run for liquidity. There's nothing hiding or masquerading price. You can see it. It's clear. You need that. You need to be able to read the story of price and not the story of indicators. So the logic is that S&P low in here was trading down into an old fair value gap over here in its price swing. But there is no fair value gap in the NASDAQ. See that? Now let's go back down into the S&P. Even my own paid memberships learning something tonight. I should have charged money for this one. Oh, ICT. Fair value gap. Trade down into it there. That's a long for S&P. But I don't want to trade the S&P. So I'm going to use the timing of that candle for my long entry on NASDAQ. Trading what's not in the chart. Hint, hint. Nudge, nudge. So market rallies. And it trades into that short-term high that was seen on, let's go back up, right here. So again, just roughing it around that 44.96, 44.90, we'll just call it 96, 44.96. And that would be right in here, bang. Hits it, sweeps it, accumulates some more, and then rallies even higher, taking out that longer-term old high. All right. What gave me the confidence that this was turning here? Well, let's take a look at the three averages together. If you look at how the market's trading low here on the Dow, this top chart is the Dow futures. The NASDAQ futures is in the middle, and the S&P is at the lower end here. So it's Dow, NASDAQ, S&P. During that decline in the NASDAQ and the S&P, look what the Dow's doing. It's saying, nah, I'm going to sit this one out, boys. It's not willing to make that lower low. Where NASDAQ did, S&P did. When you see that right there, and here's an important thing, you anticipated already. You're not looking for this. This is what some of my students, when they come into my mentorship, they see this pattern, they think, oh, it's diverging, so that means it's going to go the other direction. No. This is something that confirms an idea that you had already established before price does what it's doing real time. What does that mean? You're already looking for a reason to go higher. So that means you're looking at an old low. Does it trade below the old low? Okay. Does it have a shift in market structure that's bullish? Yes, we saw that in the S&P, but we did not see it in NASDAQ. No evidence whatsoever was in NASDAQ this morning with what I'm teaching you. But it was. Listen, it was in the S&P. And no, I don't trade the Dow, but I utilize it like an indicator. It's not plastered all over my chart. I'm referring to it because I have multiple monitors. I'm looking at my screens. I have a screen that shows charts like this. So I'm looking at the relationship of all three averages stacked over top of one another. And if I'm looking at a period of time and an area in price action that maybe is going under accumulation for long positions, this is what I'm looking for. I'm looking for that little fingerprint of the algorithm. What this is indicating is the Dow is unwilling to go lower than that low. That tips off individuals that are looking for cracks in correlation. Okay, correlation would be they are moving lower here, here, and here. But that correlation where they move in tandem together cracks here at a very important time. Right when the NASDAQ and the S&P are trading below its old low. I get questioned all the time. ICT, how do you know it's going to be a fake break below an old low and rally higher, or a fake break above an old high and go lower, which is what I dub a turtle soup. Now, that's not the same pattern that is taught in Linda Raschke and Larry Connor's book, Street Smarts, which is actually an excellent book. I have my own interpretation of that, which is very easy. It's simple. There isn't I'm not going to teach their pattern. Go buy their book and, support the authors. But the idea is I'm looking for runs above old highs to set up a short position if I have the opposite of this condition here, where maybe the Dow didn't make a higher high, where the S&P and NASDAQ did make a higher high. By itself, it doesn't mean anything. So many students over the years have simply went in there and said, oh, this is magic. I'm going to go just do that. And I unwillingly did the same thing when I first started observing it. I'm like, well, I don't need to do anything else. I'll just look for this. And it didn't work out well. Okay, I blew accounts. Yes, I'm not ashamed to say it. In the 90s, I blew accounts doing this very thing here, just looking for these divergences. And then I later learned that I have to have some kind of narrative as to why this would even form. And to be honest with you, I don't personally need to see this because I know what I'm looking for. I already know that it's going to create this divergence at the times I'm trying to buy. But as a developing student, you may not have that experience, and there's nothing wrong with that. And you may be trading longer than me. Maybe you've been trading 31 years, There's nothing wrong with that. Maybe you don't need this either. But for a developing student, someone that doesn't have a affinity for reading price action naked and not using indicators, these are the best indicators you're ever going to have. You don't need moving averages. You don't need stochastic. You don't need Fibonacci. You don't need any of that stuff. Okay, you don't need it. The only reason why I'm pulling a fib up is to show you where the midpoint is. Have you noticed that? We haven't even talked about optimal trade entry. None of that stuff. I've stripped this down to the chrome. And it's beautiful, is it not? It's easy. It's so simple. It better be easy enough for my daughter to do it. Because if you can't do this one, I don't have anything for her. But nonetheless, I want you to think about how this pattern confirms the accumulation of long positions. Now, let me correct those of you that are going to take this information and run out there and create your own videos or your own little courses or your own little mentorships, okay? Because if you don't do this right, you're going to hurt the people that are listening to you. And I just don't want them to get hurt because of your lack of understanding what's going on. The Dow is not going down because buyers are coming in. That's not what's happening here. That's what authors and book writers and people that don't really trade or code algorithms will have you believe. This is an unwillingness to deliver to that low. This is a macro. A macro is something inside of an algorithm that prevents or enables delivery. Delivery of what? Price. So the Dow is unwilling to go lower here. Okay, by itself means nothing. Does it happen at the same time that the NASDAQ went lower? Yes. At the same time the S&P went lower than that low? Yes. Okay, so let's go back. Here's that old low prior to 8:30. Remember, algorithms run on time and price. Not price and time. Multi-level marketers. The low, that's the price, yeah. But you have to refer to time first. What's the important factor of time? 8:30, go to the left. What's the first low? Right there, boom. So there's liquidity below that. It trades below it here. Then wait. Do we get a signal that allows us to hunt what I'm teaching you in this mentorship? There's a swing high. It breaks it there. So now market structure has shifted bullish. Look back through this price leg. There's your fair value gap. Oh, but what happens if it goes down there and it keeps on going? That's what your stop is for. Remember what I said earlier in the video? Some of you are so new. Okay. Your infancy as a speculator and trader it's getting in the way of sound logic. Because what you're thinking is there's a way for you to trade and never take a loss. There's a way for you to somehow, and this is nowhere near true, that you could enter the market and your stop never needs to be placed because you're right. Because what you're saying is, I'm afraid to be wrong. That's a psychological barrier that you need to get over, because I'm going to show you my live account, and there's going to be some negative numbers there. Those negative numbers sometimes are premium payments for me to get more intel. Okay? And with that, let's go into the continuation of this.